Hi everyone, Nathan Jennison here talking about FHA loans and house hacking. This has been a topic that has been in the news for many, many years, but ultimately is a really strong idea of using a FHA loan for a first-time home buyer to get into a primary residence and ultimately buy a property that has multiple units using rental income from those other units to not only qualify for the property, but also to lower overall monthly expenses for the household and ultimately save and start a real estate portfolio. The idea is strong. This article is written by The Ascent, a Motley Fool service. This was published April of 2024, in which case this author is describing how he was able to purchase his first home using this method. Now, something important to understand is that as of November 18th, 2023, Fannie Mae and Freddie Mac changed guidelines that actually allows a conventional loan to be able to be used to purchase a multi-unit building with much less down payment than was previously required, now only 5%. So essentially, you could use an FHA loan at 3.5% or a conventional loan at 5%. However, there are some nuances on the lending side regarding each that need to be understood. So, real quick, what we're doing here is a scenario. We have a first time home buyer currently spending $1,500 a month on rent. If this person were to go and purchase a single family residence, in this scenario, the person can spend up to about $280,000. As far as they're pre-qualifying using an FHA loan, they're doing 3.5% down, 6.25% interest rate, which is basically generally where interest rates are at on FHAs as of today. And they have about a $2,400 monthly payment. Now, if they're purchasing a two-unit building, we can take them up to $350,000. Again, same interest rate, and we're taking that monthly payment to about $3,000. But they're getting $1,500 a month in rent, so that's going to overall lower their monthly out-of-pocket expenditure. If they go to a three-unit building, now we can take them to $400,000 purchase price and raise their monthly payment to about $3,400 a month. The benefit being is that they have $3,000 of income coming in. But here's the rub. When we move from an FHA loan to a 3 or 4 unit building to purchase, we suddenly have a self-sufficiency test that we now have to pass. Now, here's how this works. If we take the rental income, let's say that we have an appraisal on it and that each one of these units would rent for $1,500 a month based on the appraisal, based on the area and the condition of the apartments. That means that we're going to have $4,500 a month of net income. Now, the problem is that we can only use 75% of that income in terms of qualifying. And so that's going to drop us to 3,375. Well, why 75%? Well, because guidelines say, hey, these properties, these apartments will be vacant about 25% of the time or need some maintenance costs. And so we can't have all of that be income. Only part of it can be income. So now we have 3,375, which would be the approvable amount of income from this property, counting all the units. Now, in this situation, the monthly payment from this property is going to be 3,370. The income that's approvable has to be more than the actual cost that is being paid on the property, including HOA dues. So in this instance, this property would just squeak by if it got $1,500 of income from each unit. So that's one of the ways that these deals can get hung very, very easily on the lending side, and one of the things to know about. Now, if you go with a conventional loan, you don't have a self-sufficiency test, so it can be a little bit easier to get done. So let's say we have $400,000 purchase. The interest rate is going to be higher than an FHA loan in most cases. And that monthly payment is also going to be higher. Depending on the credit score, mortgage insurance may also be a lot higher using a conventional loan. That's some of the downsides. The benefit, no FHA self-sufficiency test. However, keep in mind that in this scenario, on the 3 or 4 unit building, there's going to be about 6 months of reserves that are going to be required, which means that you're going to need to have some cash to spare or potentially have a retirement account that counts as reserves to be able to get this deal to close. That's a few of the bullet points. If you have more questions or are interested in this, please reach out to us. We'll run the scenario for you. Talk to you soon.